Hey, Bulls and Bears, we are back with another episode, another report here on the slow motion economic collapse slash financial crisis. And yes, we're sliding deeper into this mess, this financial mess. If you look back, every 8 to 10 years, typically we have a severe economic downturn slash recession. You look at the 2000.com crash, look at the 2008, 2009 housing bubble market crash, 2020 things should have imploded. But what happened instead with all the stimulus and the quickness of the reaction to it, things instead of imploding, exploded. And we're talking about exploded into the stratosphere. Instead of falling prices, we had rising prices and inflation that we're still stuck with today. And we all knew this was going to happen when we saw the amount of the rescue programs, the stimulus, the amount of debt just stacked on top of debt, record amounts of money printing, in that 2020 downturn slash economic shutdown is what it was. In a shutdown where people stop working, you should see deflation and falling prices because demand drops off of a cliff. Instead, you saw the exact opposite happen where demand increased because all the money that was given out, not just to the people, but the paycheck loans. Now, what's crazy is that people earn a lot more debt now than they were back then before the health crisis. A lot of the protections are still in place in some cities. A lot of cities now are finally getting rid of the protections here 3+ years later. We still have students that can't repay their loans, and they're talking about having that restarted here with the student loans. The students are not going to be able to repay their loans. Most students can't even afford to move out of their parents' home, but they think they're going to start repaying these loans on top of buying these expensive vehicles and paying for expensive fuel and paying high rents and high home costs. It's not going to happen. So there's going to be probably another, could be permanent, or they're going to have to just get rid of the debt, the student loan debt. And some people say, they shouldn't delete the debt. The students should pay for it. On one hand, I agree the students should pay for it. They did sign for the loan. But on the other hand, listen to this. Here's the argument that I hear that I can see the point here. You can go out and run up a bunch of debt, Joe Sixpack, go to the casino, go to the bar, go to the clubs, throw money, who knows, at somebody spinning on a pole somewhere, and you're allowed to discharge that in bankruptcy. But a 17 or 18-year-old that's not even old enough to decide to drink or not, or they're not legal to have a drink, 21 is the age, right? They can go ahead and get into tens of thousands of dollars in debt at that age, and no chance to ever get out from under it, no chance to discharge it. In some rare cases, they discharge it with cases of fraud and stuff like that. So you got to look at the big picture here as far as discharging debt. If people can discharge debt from money they go on vacation with and have parties with, why can't they discharge student loan debt? Anyways, they're not going to be able to repay it. It's going to be another, I think, permanent rescue program, or they're going to have to finally just delete all the debt. As crazy as it sounds, that's what's going to have to happen. But here's what's going on with the economy, folks. We've got a lot of things. I think we're really approaching the cliff this time. And some of you will say, I've been saying this for years. No, what I've said for years is they can keep kicking the can down the road with more rescue programs, more money printing. There were people that thought that we would see zero bank failures because they said they can just print the money and rescue all the banks. Well, obviously that didn't happen. The banks did. Some of the banks got rescued. I mean, they got bought up by, look at what JP Morgan, bought a failed bank. We see FDIC came in with the treasury and the Fed combined and bailed out basically billionaires that had more than $250,000 in that was supposed to be the limit that you could get insured for under FDIC. But we saw people with millions of dollars, billions of dollars with a B, get rescued. They went outside the guidelines. They went outside what the laws were. They changed the law over the weekend, and now we see billionaires getting bailed out. The too big to fail billionaires, the too big to fail banks are too big to fail. You and me, good luck getting bailed out. We'll probably end up filing bankruptcy if we end up insolvent, kind of like a lot of the banks right now. And I'd venture to say most of the banks. What hasn't happened yet, though, is enough people haven't went in to get their money at once out of all these other banks to cause, the financial panic and to cause these banks to have to get rescued also, even the too big to fail banks. All right, but here's what Janet Yellen's saying. She's saying that if we don't pass the debt ceiling, it's going to be an economic catastrophe. Also, Jamie Dimon's out there, JP Morgan, also saying he's warning of a catastrophe, and that they're putting together basically a task force to prepare for what's going to happen if the debt ceiling is not passed. Also, Janet Yellen's out there saying if Social Security, or she's saying if the debt ceiling is not passed, Social Security checks could be stopped, meaning people will not get paid their monthly payment. So she's definitely putting the fear out there. Now, some people say, oh, they have to pay us. We paid into it. They just need to give us our money back. People getting on Social Security, people collecting Social Security say that. I've even seen the comments down here in this channel. Well, here's the thing. You paid the money in. Do you think the money's still there? Do you think they took your money that you paid in through your whole life working, and do you think they put it in a vault somewhere and you think it's still there right now? No, it's just like when you put your money in a bank. It's gone. It's loaned out. It's spent. It's invested. Whatever you want to call it, it's gone. So people that think the money's there and they're going to get paid no matter what, no. And think about how similar this is to a Ponzi scheme. A Ponzi scheme, you always have to have new money coming in, new investors coming in to pay out the investors that got in first. And that way the cycle keeps going. Once new money stops coming in, the Ponzi scheme implodes on itself. And of course, we've seen many examples of that over the years. Well, this whole thing is a Ponzi scheme. And as soon as the debt stops coming in, or new debt to add on top of the pile, then this Ponzi scheme comes crashing down. And that's why they're warning of a catastrophe. Now, as far as what Jamie Dimon is out there doing, here's what is reported here out of Bloomberg. In an interview with Bloomberg, Dimon said he's put together a, quote, war room at JP Morgan to plan for contingencies around a potential U.S. default. So even heads of banks know that this whole thing is a Ponzi scheme waiting to implode. As soon as we can't add more debt on top of the already humongous pile of debt, the bankers even know what's going on here. But also Janet Yellen's out there saying she expects more mergers of banks, and she's talking about small and mid-sized banks basically getting bought up by bigger banks. And we see that JP Morgan's out there, did a rescue with a failed bank. And so we're going to see this consolidation continue. We're just getting started. People think they're out of the woods. We're just getting started. We have not seen the full crisis yet like we should have saw back in 2020. Could they come in and create trillions of dollars out of thin air and keep this thing going? Yes, but here's the thing. We've got inflation. We've got this inflation monster now that we didn't have in 2020. It started in 2020, but coming into 2020, it wasn't that bad. I mean, home prices were overpriced, but everything wasn't overpriced like we're seeing now. Mostly everything now is way above what it was just a few years ago. So we've got this other, force they need to contend with. And if they start cutting rates or doing an emergency pivot, it's going to be a disaster just in the other direction with more inflation, more rising prices. There's actually bets out there. You can go actually bet and try to win some money on what the Fed's going to do, or you can just invest. I try to invest both directions. If you're going to see massive inflation, you want to have something that's going to go up with inflation. I think precious metals ultimately is going to go up, one, because of inflation, but two, the monetary system that's failing now, ultimately we're going to have to go back to hard assets. And I think the next one's going to be another fiat fake money system. They're going to try to force on the people. But we're going to see that fail too, and therefore precious metals is going to be the only solution at the end of the day. But we could see a lot of pain and a lot of carnage before then. Speaking of pain and carnage, the food lines are exploding. We have late payments now, the worst the worst that they've been since before the pandemic. This is out of American Banker. After late payment rates on consumer loans fell during the pandemic's early stages, lenders spent the last 2 years waiting for what they called a normalization. The return to normalcy is finally here. Delinquencies on credit cards and auto loans have recently either nearly reached or surpassed their pre-pandemic levels. It's really slow motion, isn't it? People thought there was going to be a crash or a collapse. I was one of the few that said, no, it's going to be a slow motion collapse, no crash. And if you look at the housing market, we were correct. Home prices actually ticked up in 7 out of 10 metro areas just in the first quarter. Car prices haven't crashed. They've come down very slowly. New car prices actually went up again. So it's crazy times, folks. The higher delinquency rates, which typically lead to banks charging off more loans in default, mark an end to a period of exceedingly strong credit performance. Of course, the credit performed strong because of all the rescue programs. So now we've got these rising defaults on top of people pulling their money out of the banks, and the banks already being insolvent even before that. But now we've got this other force here with the defaults, money leaving the banks, consumers getting tapped out, and it's just a big snowball that I think is going to get bigger. Also, we've got unemployment predicted to tick up, and that's the central bank actually making the prediction. The most recent projections from the Fed show that officials expect unemployment to rise to 4.6% by the end of this year, by the end of 2023, and that's going to be up from 3.5% where we're at now, is what they tell us. I mean, we know the real number is a lot higher than that, but if you just look at the official numbers, they're saying it's going to go from 3.5 to 4.6, and that's going to equal millions of job losses if it ticks up even that from 3.5 to 4.6, right? So strap in, folks. It's happening, and it's continuing to happen. It's not nothing's getting put in reverse. It is very slow, though, isn't it? So that's good. It gives us more time to prepare, and I hope everyone here is ready for what's coming at us down the road, right? Keep stacking, keep preparing. Big love. Hey, do me a favor. Reach out to someone that you haven't spoken to in a while, even if it's just a text message or giving them a call. Texted my cousin that I haven't talked to in a couple of years up in Michigan, and had a great conversation. She was thrilled to hear from me. I was happy to talk to her. It's a great thing, right? So I just always wonder why I don't really keep in touch with relatives that I love, So do that. Do me a favor. Reach out to someone you haven't talked to in a while, even if it's just a text message. It's a good thing. And, let's make the most of the time we have here together, folks. All right. Keep stacking, everybody. Peace.